Imagine this. A world-famous dancer, right? Not some Wall Street type. Develops a trading system.
Yeah, and supposedly turns a pretty small stake into a fortune.
Exactly. So today, we're doing a deep dive into that system, the Darvas Box method. It's really a blueprint for trend following and managing risk.
And our mission here is to kind of unpack how it works. It's really surprising origins.
And why it's still, relevant today, even with markets moving so fast. We're looking at articles, research, historical stuff on Nicolas Darvas.
It's quite a story how this, well, unlikely background led to such a structured system.
Totally. So Nicolas Darvas, he was Hungarian, an economist originally, fled the war.
And then becomes this massively successful professional dancer in the 50s, one of the highest paid.
Wild, right? And his start in trading, pure accident, got some mining shares as part payment for a gig.
Uh-huh. And then just forgot about them for, what, couple of months?
Yeah, 2 months. Comes back, checks them, and they've nearly quadrupled, made like $8,000.
Wow. It's funny how just forgetting about it was his first win. So different from the system he built later.
But that luck didn't last. His first real attempts at trading were, well, pretty bad.
Oh yeah, disastrous apparently. Chasing hot tips, getting emotionally attached.
Juggling like 25, 30 stocks at once.
Only to make, what was it, like $1.89 after commissions? Just peanuts.
It's incredible. But then the weird thing is, his dancing career actually helped him trade better.
Paradoxically, yes. Being on tour thousands of miles away from Wall Street, Paris, Saigon.
Right. He could only get week-old copies of Barron's and send telegrams to his broker. That's it.
And that distance, that isolation, it forced him to be objective. He couldn't react to the daily noise.
He had to rely on the data, on a system. It stripped out the emotion.
Exactly. And that led him to read, what, over 200 finance books?
Yeah, and developed this hybrid approach he called techno-fundamentalist.
Okay, so what did that actually mean? How did he pick stocks?
Well, it was a two-step thing. First, fundamentals. He looked for companies in, like, booming industries back then. Electronics, missiles.
Stuff with real growth potential.
Right. And not just strong earnings, but accelerating earnings. That was key.
Okay, so that's the fundamental filter. Then came the technical part.
Then came the box theory. That was his tool for timing the entry and managing the trade itself.
So let's break down the box. What is it, essentially?
It's basically a picture of the price consolidating, taking a breather within an uptrend.
Right, like a temporary pause where buyers and sellers are kind of evenly matched for a bit.
And building it is simple, in theory. A stock hits a new high.
Uh-huh.
But then for the next 3 days after that high, it doesn't go higher. It stays below that peak.
Okay, so that peak becomes the box ceiling, the top.
Yep. And the floor is just the lowest point the price hits while it's forming that little consolidation pattern.
Got it. Ceiling and floor defined. Now, the crucial part, the buy signal. When do you jump in?
It's when the price breaks decisively above that ceiling. But, and this is super important.
There's a catch.
Yeah, kind of. It must happen with a big, noticeable jump in trading volume.
Ah, the volume confirmation. That's classic. Shows real conviction, right? Like institutional interest, maybe.
Exactly. Not just random market jitter. It suggests, the smart money is moving in.
Okay, so you're in. But Darvas was also big on discipline, especially with exits. How did that work?
Immediately after buying, he'd place a stop-loss order just below the floor of the box that was just broken.
So defining your maximum risk right from the start, very disciplined.
Totally. And then here's the clever bit.
Yeah.
If the stock kept rising and formed a new, higher box...
He'd move the stop loss up.
Yep. Moved it up to just below the floor of the new box. It's a trailing stop, basically, but tied to his box structure.
That lets the winners run while locking in profits automatically. Very systematic.
And he didn't just ride the winners, he added to them pyramiding.
Right. Adding more money to trades that were already working, like that Lorillard trade example.
Yeah, he bought initially, then added more at higher prices as it broke out of new boxes.
Which is the opposite of averaging down on losers. He focused capital on strength.
So even though this was the 1950s, these core ideas, buying strength, managing risk strictly, staying detached, they still hold up, don't they?
Absolutely. Timeless principles. People adapt it now, maybe mix it with moving averages, use it in Forex, even crypto.
And the profit thing, he claimed $2 million, but investigations found it was closer to $216,000.
Yeah, from about $36,000 starting capital in 18 months. which, okay, isn't $2 million.
But it's still a massive return, like over 500% when the S&P did, what, 53%?
Exactly. That verified return still proves the system's power. It validates the whole systematic approach, even if the headline number was inflated.
So the Darvas Box, it's more than just lines on a chart. It's really about discipline, combining insights with strict rules.
It's a testament to building a mechanical process to overcome emotion in markets.
Definitely. Darvas found success by filtering out all the noise. Makes you wonder, what kind of noise, what information overload or emotional reactions could you filter out to get an edge in whatever you're pursuing?